Welcome, everyone. We're live and ready. Today is going to be a topic that is incredibly dear to my heart, which is stablecoins and payments. And we're here gathered with a group of people that are not only experts, but have also been in this space for quite a while, and as such, been able to live through the evolution of stablecoins, and as such, all working today as experts in the field on the topic at hand. So I'm very excited about the conversation itself. We're going to be covering predominantly payments and the way that stablecoins are leveraged. There's lots of movements in the space, lots of movement in the industry, lots of questions as well. So I really look forward to this conversation today, and I welcome you all as part of this Keyworks conversation. So we'll do a short round of intros, and that way we're gonna dive straight in with the topic at hand. So I'll maybe start with Ben. Ben, welcome.
Thanks, Stef. Great to be here. My name is Ben, head of stablecoins at Bitso, as well as our issuer arm, Juno. So Bitso, in addition to being a crypto exchange and a big player in cross-border payments using stablecoins, also issues a Mexican peso and a Brazilian real stablecoin. And you can think of me as the GM of our issuance business. Excited for this call.
Thanks, Ben. Arnold.
Thanks, Stef. Hello, everyone. My name is Arnold. I'm CEO and co-founder of Sphere. We're a B2B payments company focusing on emerging markets. Sort of our, I suppose, niche is within more brick and mortar type industries. Think oil, gas, fabric, meat, the whole spectrum. And within that, I suppose, realm, our claim to fame is latency, aggregating various liquidity providers and speeding up the payments as they touch the banking layer. So also very excited for this chat.
Thanks, Arnold. Last but not least, Julia, welcome.
Thank you. Hi, everyone. My name is Julia. I lead Corp Dev and Strategy at BVNK. BVNK is a stablecoin payments platform, so we enable businesses to seamlessly move in and out of stablecoin, to send stablecoin, to receive payment in stablecoin, to store it. And we currently work with some of the largest enterprises globally, be it a dLocal, Rapid, Deal, and many more to be announced soon.
Great.
Excited to be here.
So what's interesting about this topic, and especially this conversation with the four of us, is that in a way we are all working to solve the same challenge, right? And we all play like a different role. Some of it is overlapping, some of it is complementary, some of it even might be competing, which is in the end of the day amazing for growth in the industry. So let's maybe dive with each and every one a bit like in depth on a market that is getting more and more saturated with service providers and actors, etc., on what specific role you play, and also how you differentiate yourselves from the rest. We've all known each other for a while, so it's really great, to be able to dive into the details. But let's maybe start with Arnold, right? You mentioned that you have a very specific focus on brick and mortar. You mentioned commodities, etc. So let's maybe share your concept and what you're actually solving versus what the rest of the market is doing.
Yeah, absolutely. So it's almost like a blessing and curse, or perhaps like a lucky coincidence, in that we got our business started essentially as FTX collapsed and during the whole regional bank crisis a couple of years ago. And so back then, stablecoins were widely considered a pretty bad idea to invest one's time into. And having just raised and convincing some of the smartest people that we knew to join us, it turned out that very strangely and coincidentally, our target customers were not the crypto companies per se that we had originally built the idea around, called a Stripe for Crypto. Instead, where we got inbound was from companies within the emerging world broadly. At the time, it was fairly concentrated in Latin America and the Caribbean. And the recurring theme was, maybe they weren't as up to speed with call it the layer 2 ecosystem. There was quite a wide spectrum of sophistication within crypto. What we noticed, though, is that they were pretty successful, at least relative to, a 4-person company at the time, within their domains. Which ended up being quite concentrated in those brick and mortar type industries. And so we ended up really investing in this audience, trying to get to know them, their problems, some of which weren't very obvious. And as an example, a multi-generational family company might just have a couple of PHP developers, if at all, let alone Rust developers or Solidity developers, even TypeScript developers, which would often be required to go and touch service providers from the developed world. Sometimes might not even speak English, or their corporate documentation is in a completely different language. And so over time, I think we've been able to foster some great relationships within the space. And because, to take like a trite example, if you're shipping fruit from one country to another, that industry has existed for arguably, hundreds, thousands of years. And so the nature of these businesses means that trust is quite important. And I suppose given the circumstances of the company, we were able to really dig in and spend a lot of time with these counterparties. I'd say that there are some unobvious steps in between getting them onto even stablecoins, whether directly or indirectly, where we've been able to find opportunities to really speed things up for them. Probably the most obvious one is correspondent routing. If you are, sitting in a country where the local, call it sponsor banks, might not have as many active correspondent relationships internationally, the default, call it pass-through of currency, might end up taking way too long. And if the type of good that's underlying the cross-border payment, say, is dependent on a ship sitting in a port, you might pay extra port fees per day that there is an extension and a given vendor payment that's required to complete the next leg of the transfer. And so I suppose based upon the region of the sender, based upon empirical patterns that we were noticing within the correspondent routes themselves, when you have a list of 30 sponsor banks within the country at all, you start to see where there might be some strange reasons why a given local sponsor bank might have faster peer-to-peer clearing with a given correspondent in a different country. We were able to start building out this map internally and become opinionated about the way that the funds should flow. At some level, transferring the stablecoin on any given chain, one could reduce down to a Web3.js like single line call to a function, to an SDK. And so that necessarily wasn't the hard part. Maybe the harder part was, of course, in the initial onboarding and education and kind of getting folks comfortable, especially if they were an FI or related and had higher regulatory burdens, and convincing them that this stuff is safe and in line with their local compliance requirements, etc. But I suppose that one particular gain in latency was an understanding, hey, if you happen to use, call it your national bank as the originator of all your funds, and that national bank rented their core, just to throw out an example from Citi in like the 80s or 90s, it turns out that it's actually faster for us to redirect payments, explicitly identifying intermediaries that have better peer-to-peer ledgers with Citi relative to other, call it T1s, if we're talking about USD in America. And so I think that combined with on-the-ground sort of engagement with local liquidity providers, some of which weren't obvious either. Not to say that we do this, but sometimes the best rates could be found through like someone who's active on WhatsApp, and let alone someone who has a stand-up company that's vendor funded and has a great website. I think understanding some of those nuances has helped us really drive down latency for these transfers. When in a typical manual escalation within a bank post stablecoin conversion, it can create problems that are unexpected. Yeah, hopefully that's provides some clarity on where we've been able to kind of carve out our niche. It's in kind of streamlining some of the usual escalation processes, and I suppose the routing explicitly on the correspondence before and after the conversion.
As a trading firm at heart, I can very much understand the latency game being of essence. So taking that as one of the main takeaways, especially during connections and trust, is interesting. So Ben, when you talk about Arnold was talking about LATAM, like we see, for example, like flows increase significantly in that region, especially when it comes to stablecoins. Bitso is by far one of the biggest leaders in the space, and actually plays a bit of an interesting role because it's a very overarching player, right? But both on the issuance of stablecoins as being an exchange venue, being able to match quite a lot of flows. So walk us a bit through on how you guys are attacking the market, how your focus is shifting maybe towards other regions in the world, and also how you're seeing Latam evolve.
Yeah, Bitso started life 11 plus years ago as a traditional crypto exchange and has grown to be the biggest fintech company powered by crypto in LATAM, was the first LATAM crypto unicorn. But then pretty early on, I'd say, saw activity with stablecoins and also put together that because Bitso had liquid books between local currencies, MXN, BRL, etc., and stablecoins, and had local ramps. So Bitso did direct integrations into SPAY, which is the real-time interbank payment network in Mexico. We're connected into PIX, which is in Brazil. That was actually a sort of unique and valuable combination as people were starting to use stablecoins for cross-border payments. So that could be useful because we can convert between fiat and stablecoins. And we can then, if it's fiat, we can either receive it or we can send it on its way. So that's what we call Bitso Business. And that business, you're right, that's another sort of touch point that's very different from the traditional crypto exchange business that we built and are now, I think, meaningful players in the space with, in terms of cross-border payments, more in than out, but that's just the nature of the flows. Like in Mexico, there's more money coming in than there is going out, but it is both ways. But it's from that perch that then Bitso got the idea to expand into kind of the third pillar of the business, which is where I'm closest to, although I get involved in the second pillar, the Bitso business side as well. But it's from that perch of seeing the rise of stablecoins and their use and all the different use cases based on the clients that were coming to us, that Bitso saw the opportunity to become an issuer and issue a peso stablecoin, addressing the obvious question, like it's early days, like dollar stablecoins still dominate all the flows in LATAM, but we thought that if anybody had kind of the ingredients to do it and give it life and kind of ride what we think is a wave that's happening, that's kind of just started and that will continue to ride in terms of non-dollar stablecoins over the coming years, we were in a good position to do it. And so that's why we pulled the trigger and built an issuance business called Juno, where not only it's just, hey, we issue a stablecoin, but in particular, we're following a similar pattern with the Bitso business thing that I mentioned, which is that we're issuing stablecoins that are directly connected to the local payment rails. So with the example of MXNB, we connected it directly to our SPAY integration. And so a client of ours can be holding pesos in a Mexican bank, and because the minting, the transfer is instant into our mint account, into our bank account for minting, the minting is essentially instant. A client can go from pesos in a Mexican bank account to peso stablecoin on chain in a matter of seconds. And that's fairly unique, and it combines kind of some of the ingredients we have to try to add value to the space. So that's where we are.
Thank you. Which gets us back to the latency game, right? I think we can all agree that stablecoins, one of their major USP is T0 settlement, and as such, resulting into capital efficiencies. Capital efficiencies being something that institutional counterparties really value, especially also those that provide services for these type of enterprises. Julia, when we talk about enterprises, typically we're talking about slow education cycles, tough to integrate technologies into existing stacks. We're talking about regulatory requirements, compliance requirements that slow things down. How do you guys work with this? How do you typically have these interactions, and how do you differentiate yourself in being able to be partnering up for them when it comes to all of these, let's say, challenges?
Good question. I mean, so BVNK was arguably like one of the first players when it came to enabling businesses to accept and send stablecoin payments. And really, our USP is that we make it super seamless and frictionless to do that. So most of the customers we work with are these big businesses that don't actually want to touch crypto. They want exposure to it. They want to enable their customers to pay in stablecoin. They want to enable, they want to pay their suppliers, their third parties in stablecoins, but they actually want to transact in fiat. So what we do is we basically make it super easy for those businesses to get that exposure with us doing everything in the back end. So we take on the regulatory burden, the compliance burden. We create UX, which is super easy for businesses. And I think a big differentiator when it comes to BVNK relative to our competitors is that we have from the very beginning gone after these really large global businesses with extremely, I guess, yeah, like deep requirements in terms of what they need. And that has, one, shaped the way that we build our technology. We have a very deep infrastructure stack, which enables businesses of all sizes to use us in a very modular fashion. So for example, we're able to support businesses that want a very low touch model, as well as businesses that want to kind of have a more modular solution, maybe want to build more in-house. So that's on the tech piece. And then on the, I guess, regulatory banking infrastructure, we have really, really deep connectivity, not only when it comes to like blockchains and supporting all different stable coins, but also when it comes to fiat, being able to support traditional fiat payment methods. And it's really that whole modularity and this really complete offering, which sets us apart from a lot of our competitors. And when it comes to engaging with these big enterprises, large PSPs and merchants, there has definitely been a shift in the way that we engage with them. Like, as you said, it was very much educational, long sales cycles in the beginning. But over the last year, with all the regulatory changes that have happened with the Genius Act in the US, we've seen that flip where businesses are now coming to us. The sales cycles are much, much faster. The buyers know exactly what kind of solution they want. So it's now less solution oriented, but more like they're coming to us, they're ready to get up and running. So it's definitely been a big shift. And I think that's something that not only we've seen, but other players in the space as well.
When it comes to regulatory clarity, one of the moves that you just mentioned, which is, more interest and more adoption of current stablecoins is one part of that evolution. A second one is, and MetaMask today created their stablecoin, is that there is an emergence of everybody issuing their own stablecoin, and both Web3 players as, let's say, more traditional enterprises, even traditional banks. What do you think is the future here? Do you feel that this is going to be a trend that keeps evolving, or do you see that there's going to be more of a tendency towards going to one specific stablecoin in order to actually facilitate adoption? Because it's always a two-edged sword, right? You want to have first retail actually using it, or people actually using it before it actually makes sense to issue one, or you tap into your existing users as an entity and offer them a stablecoin the other way around. So Ben, you've been part of quite a few organizations that have been very active on that front, and now with Bitso as well. You should be focused on that. What's your view? Are we going to see a world where everybody creates a stablecoin, or you see centralization happening?
I hope we are not in a world where everybody creates a stablecoin. I think I may be wrong, but I guess I just view back to like the wildcat banking days where every bank had its own bearer note and it created all kinds of issues. I know we're smarter than that. And then the answer is like, oh, well, it just needs interoperability. And there's things like Ubix, for those who are familiar, that are trying to create like standards for acceptance and stuff. But I think it'll be a crazy world if we have 1 million stable coins. But maybe there's nothing stopping that. I do think you mentioned something though, which you were talking about. You kind of were talking about retail and customers and stuff like that. And I will say, maybe a hot take, one of the questions I always get as a Mexican peso stablecoin issuer is from a very retail centric lens. The questions I get are from a retail centric lens, which is how a lot of people's sort of priors is where they come from on stablecoins. They look at it as like, oh, it's what it's what retail uses to trade crypto in certain regions, or it's what people in certain regions hold in order to prevent hyperinflation, and that's kind of the lens. And they say, well, so what are people going to do with the Mexican peso stablecoin? Are Mexicans using it to buy coffee? And the answer is no, and nor do we expect it to be that. And so I guess a hot take, I don't think it's that hot of a take, is that the majority of the use case for the near term for stablecoin growth that we're looking at is more on the business side. It's not to say that there's not a retail angle. I have a thesis that and obviously I have a non-dollar stablecoin lens, so I'll speak from that. A thesis that dollar stablecoins kind of followed like a grassroots to institutional arc. It started grassroots because of the reasons we all know. And then institutions were slow to come around and they were waiting for clarity and stuff like that. But now finally we're kind of at that point where they're now scrambling and tripping over themselves to have, in particularly, a dollar stablecoin strategy and get that in place first. The thesis is that the non-dollar wave that I think is happening, that's already in play, but will play out, will go in reverse. It will go institutional to retail, and that there's much more clear use cases today on the institutional side. Are we going to see proliferation of stablecoins at the institutional side? I don't know. Amazon might issue their own stablecoin. I could see that, or a company like that. I hope we don't get into thousands and thousands of stablecoins because it's kind of a mess. But I guess we'll see.
Arnold, what's your view? Do you feel that, because it's an interesting perspective, right, Ben, yet you think it's actually going to take almost a reverse adoption cycle, which I kind of agree with, in all honesty. I think probably we're going to get into a world where people don't really know if they're transacting a stablecoin. They're transacting a piece of value, and it's a UI thing that is going to make a difference. Arnold, like, what's your view on looking then at like almost institutional on-chain FX markets? Do you think that's the route? Do you see that also being of interest for a lot of your LATAM counterparties that are looking, to do cross-border transactions? Do you think that's going to be one of the first use cases?
I feel like for majors, probably no. Like ECNs are pretty efficient. Although, I mean, the daily turnover for FX is, you're at KeyRock, right? Like trillions a day. But if the currency accounts aren't available, it could open up net new order flow where the on-chain FX might become more relevant, and the margins are probably more palatable because these are counterparties that can't have those currency accounts by default. Generally, though, I think I would agree with Ben. Like, probably everyone will try to create a stablecoin because everyone is FOMOing Tether's quarterly profits. And there's like no reason to not have a stablecoin, at least in the world today. And I think like it's easy to underestimate the amount of work that goes into interoperability, regardless of how the model for bridging is done. It's very difficult to handle edge cases, like call it relative constraints and liquidity, or atomicity between different environments. And you probably have apps try to capture a lot of that value downstream by offering ecosystem benefits. Like JP Morgan's coin is kind of like a tokenized DDA more than maybe a traditional definition of a stablecoin. But it's super good if you're like a JPMC customer transacting with another one. And if I like zoom out and I think, okay, well, Uber maybe has their own stablecoin, Airbnb has their own stablecoin, they could probably offer perks, because really the exchange that's happening is that what was previously a separated payment instrument versus like a yield instrument is now being combined into this one type of instrument. And so if Uber incentivizes people to hold balances within app, in essence, the customer is paying for perks with the underlying yield that they would otherwise accrue if their cash were sitting at their bank instead. In the, call it 10, 20, I don't know, maybe it's just a couple of year frames. The future is hard to predict. It's hard to see like why a lot of the advantages are lasting outside of apps with very sticky, call it relationships with the user. And maybe just on the pure yield use case, the economics kind of progress it towards money market funds or mutual funds or kind of like very commoditized types of goods. But I suspect that if you are like an Uber or an Airbnb or, you know, an Amazon or something like that, it kind of makes sense for you to have your own stablecoin because you control the customer and you can get paid for the customer's yield in exchange for what could be analogous to like airline points. My only concern is that that cycle where a lot of people discover that they probably don't have a very competitive stablecoin almost necessarily plays out. And in the meantime, there's going to be a lot of saturation, perhaps, or maybe one could describe it as a work that, you know, if we were all rational, might not be as necessary in terms of interoperability. And I worry that, you know, maybe people, especially if like this is coming from like a business strategy perspective, are not as maybe aware of some of the edge cases that occur in technical implementation when you're trying to like interoperate between a million different stablecoins. But you know, either way, it's probably good. Or I don't know if it's good. It'll probably happen.
I mean,
Ben,
maybe
you wanted to chime in,
building,
or Julia? Yeah, go ahead, Julia.
I was going to say, building on that, like my thoughts around this are that people are already, like businesses are out there wanting to launch their own stable coins. And I think we'll see more and more of that, to Arnold's point. Like we will see big brands, whether it's a Revolut, whether it's a Walmart, launching their own stable coins. And we will see that proliferation. I think the key question is who is actually going to win. And I think the reality is that stablecoins do have a very, very strong first mover advantage. So as we've seen with Circle and Tether, they've been around the longest. There's a huge network effect just by virtue of the fact that the more people use USDC or USDT, the more valuable it becomes, the more the easier it is to transact with it. So I do think that there will be that concentration amongst a few of these big stable coins. And for most of the others, unless there's a unique distribution advantage, hook, or brand, it will be very difficult for these stable coins to take off. So only really like the largest businesses that have these unique, you know, distribution advantages are gonna succeed. And then ultimately, when it comes to USD versus other local stable coins, I think it will kind of mirror what we're seeing in the traditional FX world, where arguably like a big chunk of that volume is done in USD. And I think it will remain like the stablecoin world will mirror that, where we have the majority of stablecoins will continue to be USD denominated, although we will see kind of, you know, more local stablecoins come to the fore as well.
Yeah.
Ben, you wanted to chime in?
I agree that like there's a series of events like Tether's profits, Tether's like per employee profit, like that single statistic probably got more FOMO and more like boardrooms talking than anything. But that Circle's IPO pop, like the series of these events has presumably a lot of boardroom discussions right now of, well, what's our stablecoin strategy? And that leads to, can we do this? Yeah, we can do this. We have huge distribution. Look at us. We're Airbnb, Amazon, JP Morgan. But almost all of those, I would say, I'll just observe something, which is that I think, I'm not in them and I don't want to discount at all the strategic intelligence and insight of the teams that would be working on this. But like, I would assume that the initial premise of, yeah, we should do this, let's pull the trigger and do it, is based on a closed loop assumption. It's sort of like within our ecosystem, look at how big our ecosystem is. That alone, let's run the math. Some FP&A person runs a model and they're like, oh, that's big. And they're like, great, let's do it. But then like I would assume there's some sort of like hope that like, oh, and then people will use Amazon coin off of Amazon. And that's where like, that gets a little bit tough. What's the plan for that? How does that distribution work? How is that going to work vis-a-vis USDT and USDC acceptance? You're going to get it on exchanges and whatnot. That, you know, again, I don't want to discount the planning, and I'm not in these meetings, but that's where I struggle. Does that mean that there's not a place for certain very large closed loop ecosystems to be able to have their own token? Yeah. You can even then press on this a step further and say, well, why a stable coin then? Like, why not just like a like Starbucks doesn't need like a stablecoin necessarily to have like their currency within Starbucks. And I don't know that there's a great answer. The one thing that I can come up with is just sort of like, if you were to do this, it's hard. You can't do it with fiat when you have a business like Amazon or Airbnb that operates in, I don't know, 200 countries, something like this. Like you need some sort of common medium, and so it works well from that perspective. But it kind of sounds like a loyalty point. You could also just call it Amazon points, and do something similar and keep it in there. But then they have to deal with all the FX. So I still struggle. I still think they're going to do it. But again, outside of their ecosystem, it's a big open question how that'll work.
I'm gonna maybe chime in there. So what's interesting, so over the last 7 years that I've been part of Kiruk, I've always been overseeing all of our, let's say, direct mandates with stablecoin issuers when it comes to liquidity, and we've seen it evolve, right? So at the start, it was a game of access, then it became a game of liquidity, institutional grade liquidity, and then became a game of, okay, how can we start building it to more RWAs, which is like, tokenized yield, et cetera, et cetera, et cetera. But I kind of feel, and this is maybe also a bit of a bold statement here, I kind of feel that we are seeing the downfall of stablecoins as a product, and that we're actually looking at the emergence of people realizing that stablecoins are a feature, right? I think that we're going to a place where the underlying yield, which by the way, today is way better than it was 5 years ago, right? Has to be redistributed because people expect it, or is being used, as you alluded to, Arnold, as a way to incentivize people to use either your coin, remain within a specific ecosystem. And as such, it becomes extremely tough to create a stablecoin and actually have a business, right? Like today, I saw an article yesterday that it costs around 50 million for you just to create a stablecoin, right? To do it the right way. And like with legal and all kind of stuff, like it just, it requires an investment. How can you build a business out of a stablecoin almost, right? If you don't look at it as a feature. So question here, and maybe going back to you, Ben, because you're working on this day in, day out, it's like, do we see stablecoins being a product, or do we see it as actually becoming a feature?
I don't know. That's a pretty deep philosophical question. But I mean, if we want to say it's a value on better rails, and that's the feature, it's money, value exchange on modern internet rails, like, and that starts to become a feature more than a product. That kind of makes sense to me. Yeah, we are, I guess, at a pivotal time, but I don't know. That's a pretty deep philosophical question. I'd be curious what the others think on that.
I went a bit rogue on that one. This has been on my head a bit. But Julia, maybe you, like, do you face a lot of, let's say, enterprise institutional counterparties that might be thinking of also issuing their own stablecoins? Do you see that they are typically using it as a means to an end, like maybe as an enabler of loyalty?
I mean, the way that I look at it is just, it's another currency. So whether you describe a currency as a feature or a product, I don't know. But the reason enterprises are looking at it is really twofold. Like one is, if you think about businesses that are enabling, that are accepting stablecoin payments, for them it's just a way to increase their addressable market. It's a way to increase conversion at checkout. So they're doing it really for business reasons. And then the ones that are paying, that want to pay counterparties in stablecoin, that's also being driven by customer demand. And it is ultimately a business decision more than like, we want to do some fancy PR and have stablecoins. Like there is now demand, both like bottom up and kind of top down to implement these things and unlock that value of having basically this new universal currency where anyone in the world can open a stablecoin wallet.
Arnold, maybe a question for you. So when you think about stablecoins and you think about latency, etc., in both instances, one of the biggest central factor of also possibly delays and also blockers is the traditional banking system, right? For the on and off ramping side of things, I think we all realize this, that over the weekends we're looking at T+2, at best. But also when you think about the issuers themselves, the underlying value of the stablecoin is typically either in fiat or in other, short-dated yield denominated products that are with the bank, custody with the bank. So what's your view on the banks being, a possible blocker? And do you think that stablecoins down the line will look different? Do you think we'll see an emergence of decentralized stablecoins again down the line?
It's a great question, and the future is increasingly hard to predict. Although we get some clues from the past, and maybe it's almost relevant to the question that you asked before, which is like most people probably couldn't give you an exact breakdown between M1, M2, M3 within those categories of definitions of money. How the nuances between different cash equivalents work is also probably pretty arcane. And if I think about like the transition of money in its different forms, probably most recently towards call it electronic money, where you can kind of see it in your bank. It's hosted on some like centralized Web2 server. And then we get into stablecoin land. Broadly, it probably becomes more invisible. And I think like the best maybe heuristic that we have is Gresham's law. For most people, like when they go to JPMC, and I'm going out on a limb here, don't speak for most people, you're paying JPMC for a lot of things, not just the ledgering or the settlement or the clearing. You're paying them for the customer support, the trust, the liability. It's a lot of like manual labor beyond just like the back end, so to speak, that a stablecoin rail could provide. And Gresham's law is super interesting because it divides money into, call it like good money and bad money. And so, within the scope of good money, I could see centralized options being really attractive for a lot of people, as long as there's some, call it minimal viable level of composability. And maybe that's where, stable coins could exist continuously as a product. It's the ancillary infrastructure, the tooling. We've talked a lot about interoperability as an example of a way that branch goes down. The other framing is where centralized stablecoins don't work. Suppose that it's a country where dollar account access by virtue of local law is just very difficult. Gresham's law would point to bad money, and maybe that's a persistent form of stablecoin as a product too. And maybe that's where like decentralized forms of stablecoins or even centralized forms of stablecoins that are more, call it willing to operate within these areas. And you can kind of look at the progression of the top two stablecoins really today to kind of see that breakdown happen out in real time. Maybe that's where you have stablecoins continue as a persistent product. But I suspect that it's in areas where I think, as Ben mentioned, step outside the app's ecosystem, and you start wondering, like, would Amazon actually be cool if people en masse basically moved out of Amazon Coin and decided to move it into like I don't know, their biggest competitor, Rakuten Coin? I don't know. Would they actually be cool with that? Because maybe it starts to make sense for them to start limiting composability in order to maximize their value capture. And I think it's at those, call it margins of tension, where decentralized stablecoins will find their place. But if we go take the, call it 50 or 100-year view, I imagine that a lot of people will probably want to abstract away some of the beneficial properties that really matter at points of tension with decentralized stablecoins. And for the most part, they're kind of paying for peace of mind more than anything else. If you think of the yield that they're exchanging for a given format of a stable.
Ben, banking is part of your day-to-day. Like, what's your view on this?
Yeah, I mean, feels to me like there's like I don't want to say love-hate, like there's some tension in the relationship between stablecoins and issuance and banks. And here's what I mean by that. There's probably a lot of different cases where you can make that case, but the specific thing I'm thinking of is, while there are like the DAIs of the world that have unique models that are, less reliant on banks, the fully reserved, it feels to me, and maybe I'm biased, that like the world is moving towards a mostly more comfortable, at least to begin with, fully reserved, reserves with banks type of stablecoin model. That's what they're used to, right? Like audited reserves and so on. And you want, and the expectation is that the reserves are invested in, if they're invested in anything, in like short-term sovereign debt of the country underlying the peg, underlying the currency. Like that's an acceptable thing. Like if I have a dollar stablecoin or a peso stablecoin, we invest in CETES. CETES is the short-term, is the sovereign bonds. It's the treasuries of Mexico. And it would be weird if I took that, and probably unacceptable, and there'd be all kinds of questions if instead we took that and we invested reserves in, the sovereign debt of Brazil, which yields higher. But like that would be viewed as weird, and there'd be all kinds of questions. Or on the flip side, even dollars, like even though that's probably more conservative, like that would be weird. So there's this expectation that you invest in the underlying debt. Where I'm going with this is, at least in Mexico, and I think this is common in some other countries as well, a citizen can go to CETES Direct and buy a CETES, can buy bonds directly from the government. A business can't. The banks have there's a requirement to go through banks. And so then you get into all the things that we were talking about of like, like weekends and their willingness to do things. They kind of control access to that. Are they going to give an account to somebody or not? And so there's still this like, yeah, I want a bank to custody my reserves, because like there's this expectation in the world that conveys trust, and like it's secure, more secure than for at least your average person who's just getting comfortable with stable coins. At the same time though, then it like overlays this layer of centralization and sort of old school TradFi practices on the inner workings of a stable coin that like I don't like, and I wish I didn't have to deal with this. So that's like a tension I see these days. It's a necessary, I don't say necessary evil. There are partners, and banks are great, but there's some tension today in sort of old versus new.
Julia, for BVNK, that's like an absolute USP, right? It's like the banking and the fiat side of things. It feels like the business is very much geared towards that, which is a major USP. But do you also see it as a possible risk associated to it? Like, do you see it as a potential blocker for growth, as over weekend liquidity, etc., becomes a challenge? Like, what's your view on that relationship?
So we see banks as key partners to our offering. And the reason being is that, as I mentioned previously, a lot of the businesses we work with only want to touch fiat. So we actually need to work with underlying banks that are going to provide us with access to the different payment schemes that are going to help us custody those fiat funds. So they are really a critical piece of our infrastructure. And I'd say that they historically posed a big challenge to us, because establishing those banking relationships is very difficult, especially if you're a small player. It can be really expensive, and obviously if you lose one banking partner, it can really impact your business as a stablecoin platform. That being said, we're now at the scale where we work with about 20 different global banks. So if there is one that like falls through, there's a lot of redundancy baked into our platform. And more than that, we see that actually banks are really willing to engage with stable coins nowadays because of the regulatory shifts that have happened recently. And we now have banks kind of approaching us, wanting to bank us. So that dynamic has also shifted quite dramatically with the regulatory landscape. And I think that banks will no longer be really seen as a challenge to stablecoin platforms, but more as like key partners. And we've seen like really positive developments on that front.
Nice. Where do you see, just back to you, Julia, it's like, where do you see then, you said you've got so many 20s, like super impressive, like where do you see the most proactive interest, like from which regions? Is this from the US because of the clarity that there is, or at least additional clarity? I just saw that DPS is launching their tokenized structured notes. DBS, in my opinion, has always been extremely proactive, but based out of obviously Asia region. Which type of regions do you see get most, let's say, interest?
I'd say we've definitely seen it on a global basis, but in the last couple of months in particular, there's been a huge surge in interest from US banks specifically. And that's not only like them providing us services, but actually them reaching out because they want to integrate stablecoins into their platform. So, I mean, it's still really early, obviously long sales cycles to sell into these banks, but there's been a real shift in terms of the appetite and willingness to actually do things in stablecoins. And it does feel like a lot of the banks that haven't yet done anything in stablecoins are feeling slightly on the back foot and now looking to catch up, specifically in the US.
It's almost like with the signaling that was occurring with Genius for months in advance. If you were a bank and you weren't starting that conversation 8 months ago, you were almost like doing a disservice to your shareholders, right? To not at least start kicking the tires. You knew it was so telegraphed.
Exactly.
You know?
Yeah. I heard that a lot of the opposing entities on the Genius Act were actually, regional banks because of depositors that said, you know what, we don't want to miss out on this possible, let's say, incredible line of business to us. But yeah, it's interesting to see how all of a sudden there's a shift. Arnold, when it comes to LATAM, which I think is, and we covered it a few times here, both from our side on the liquidity side of things and with obviously Ben at Bitso. But when it comes to LATAM, and especially with commodities, which is just one use case of the counterparties that you're facing, is there's lots of flows between Asia and LATAM actually when it comes to commodities. I'm not sure if you're seeing the same. Do you see that as well? How do you see Asia emerge more and more when it comes to stablecoin trading, besides the USDT angle that there was in the past and all like the perps exchanges being set at the USDT? I think that's maybe a different use case. Do you see something else happening right now as well?
Yeah, so I'm actually doing this from Korea, and I'm pausing because there's certainly it feels like a lot of movement towards regulatory clarity within East Asia, namely within Japan and Korea, which have historically maybe been a little bit less clear. I think Genius though has really incentivized movement because if you're one of the largest owners of U.S. sovereign debt, call it a Japan, or there are considerations that your citizens might be moving into USD stablecoins with the gateway, so to speak, opening up post-Genius. All of a sudden, it becomes of a high priority for most countries, really. But we've noticed increased maybe flow or increased signaling from Korea and Japan to start participate more actively. Broadly, though, it feels like probably similar to you guys over the last maybe 12, 18-ish months, increasing amounts of appetite, call it from Asia to LATAM, LATAM to Asia. LATAM, broadly, I feel like has new sets of destinations or origins of flow that when we at least started our journey and to kind of take with a grain of salt, we're just one company. And when we were beginning, we were 4 people. But we have noticed, whether it's us or with friends, partners, customers within the region, vendors, higher amounts of, call it, implicit adoption. And I'm imagining that some of what we're seeing from, call it, Financial Services Commission here out in Korea, or the release of the new JPY coin over the last week in Japan, Hong Kong as well announcing more movements alongside the two for regulatory sandboxes. You'll probably see trickle-down effects, although I know that MAS is tightening up given how much of a center point, or I guess hub it was for historical crypto activity trying to reach the APAC region broadly. So TLDR is yes, we also notice it, and I guess that's why I'm here. And it's probably going to increase, and the sources of countries in name will probably become further diversified. I guess is yes, what I can say on a public podcast.
It's great, exciting. That's like almost a hidden announcement or announcements. We're looking forward to it. Ben, obviously Mexico, Brazil, these are regions that have been more and more established as regions where not only stable coins but also the adoption of digital assets has become a thing. What other regions do you see, maybe within LATAM or anywhere else, as being the next big wave of adoption?
You know, the way we've looked at it, there is a little bit of like obviously our focus is on LATAM, and there's a little bit of a country by country view, and they're all different in LATAM, like the situation and the government and the regulatory standing. You have like El Salvador that's already dollarized. You have like Brazil, which is doing crazy things with tax law and regulations every day. Like everyone's a little bit different. So we have our views on like country by country. However, in terms of like the what's next, we look at a little bit more. I've spent more time thinking about the what's next on the use cases and adoption in the region or inter-region. And something that you touched on is like there is big flows between Asia and LATAM, and so, but that often gets overlooked because people think first. Again, I think there's such an initial retail view that it focuses first on remittances, and so people think, oh, it's like U.S. to Mexico, and that is big, but it kind of overlooks a bit of the some of the stuff that the Key Rock report I think did a phenomenal job of touching on with on-chain FX. I mean, there's the FX piece, but implicit in that is also what my friend Nick from Zodia talks about a lot, which he would call wholesale finance. So like, and I think what Sphere spends a lot of time on, like Asia there's companies in Asia that are buying $100 million worth of an agricultural product for Mexico at one time, or $50 million worth of textiles from Brazil at one time. And there's massive reasons why the atomic settlement, like settlement risk gets, like massively improved. That there's reasons for stablecoins to be adopted there. And that's something that we're really focused on, that which regions then are potentially the biggest ones to play in those sort of flows. And it's no surprise that we're involved in Mexico and Brazil, which are the two largest economies in the region. And you could rank order them from there. But that's what makes us really excited is those sort of things. And there's one more thing that I think it's not directly addressing the question, but I just want to call out that I think the report did a really great job of addressing, and I'll point out, which is that whether it's business or retail, the whole world is not looking to get dollarized, contrary to potentially popular sentiment. And even if some countries are mildly inflation, sure, you have the Argentina and Venezuela stories that always get pointed to. Mexico is mildly inflationary to the dollar. And actually, if you had held the peso over the past 6 months, you would have gained 20% versus the dollar. So it's not so black and white that everybody wants to hold the dollar and they're always better off holding dollars at all times. And that extends to businesses as well. I'd like to say Mexicans live their life in pesos, and that means the Mexican businesses run their business in pesos. And there are deep implications there about, like how stablecoins can help and the role of certainly non-dollar stablecoins. But I think the report did a great job of that. And so I don't know, that's what we spent a lot of time focused on. I think the report did a great job of touching on the things that we're trying to build to.
Thanks, Ben, and great to hear you appreciated reports. We're nearing to the end of the podcast, so I have a bit of a fun question, let's put it that way, and it alludes to the fact that you mentioned, Ben, that you don't think that the stablecoin world is going to get dollarized, or at least as much dollarized as today. So first question is, do you think that USDT will remain the biggest stablecoin forever? Probably forever is a bad question, but do you believe for the next 5 years it will be the biggest? If not, what will be the biggest be? Just a round of questions and maybe a short context as well. So maybe Julia, you think that there will remain the biggest in 5 years?
I think for the next 5 years, yes, because as I mentioned, there is such a strong first mover advantage and brand recognition, specifically in emerging markets around USDT, that I think will be very, very hard to disrupt them. I do think that as we see a lot of these business use cases for stable coins emerge, it might be that we'll see other stable coins be used more than USDT. So like USDC for like any US-based businesses that are transacting internationally might kind of start catching up / overtaking USDT, but it's fair to say in the next 5 years, I think USDT will still be the market leader.
And so if it ever gets overtaken, will it be a company like USDC, like Circle, or will it be the Walmarts of the world?
I think tough to tell, but Ben made a really good point that it's very difficult for these companies that, like Walmart, that are more like closed loop ecosystems, almost like point systems, for their kind of stable coins to really gain mass adoption.
Ben, what do you think? 5 years?
Yeah, it's hard to bet against Tether. I also would just acknowledge they're a savvy operator. I think sometimes they get a bad rap, but if you get to know the company, I think they're a very impressive company. They're intelligent, and they have a massive war chest. They're not, when there's this like, oh, Tether, USDT is the unregulated and Circle's the regulated, like that's not static. And you only have to look to the recent hiring. If you guys saw the headline the other day that they hired Bo Hines, to understand that they understand, and there's things happening that they're not going to go down, on those grounds. So I wouldn't bet against them.
Okay. If ever they become second, who will be first?
I'm going to say I'll make a blind prediction that it would be, if that was the case, it would be something we're not even talking about here. It'll be something we're not thinking about.
Something Bitso has issued, then.
Something we're working on. Yeah, exactly.
There you go. Arnold.
If by biggest you mean market cap, I think the answer is less clear.
Good one.
I think it's very possible at the scales that we are today, a large player can kind of just print way more than exists in the market. If by biggest you mean most widely used, call it by the largest number of human beings, I think probably still will be Tether in 5 years. But a lot can happen in 5 years. But yeah, Tether is very bullish.
I think that's a savvy, nuanced interpretation, Arnold. That was a good call.
Yeah, that was very good. Very good. If I had to give my 2 cents, I think that we might evolve into a world where the USDT, CB, whatever it is, will disappear, and that the underlying inner workings might be fluctuating over time, and where like the supply on Tether might be more than the one on Circle or the one over there, but that we will not know. It will be something opaque somewhere for people that are only interested in it, and institutional counterparties might look at it from a counterparty perspective, but you never know. It might be just USD. On that note, I really want to thank you all. That would be ideal indeed. Yeah, thank you very much for joining. This was super insightful. We can always, if you really want to go into the depths of what we also discussed today, the report is ready available for everybody to read. But I really want to thank you for your time and your input, and I wish you an amazing rest of the day. Thank you.
Thanks a lot, everyone. Bye-bye.
Thanks, everyone.